Welcome to the 2022 Federal Budget Targeted Overview. This year's budget is focused on the two themes of economic growth and making life more affordable. As always, there's a lot of content in the budget, including information that may not be of general interest. This targeted overview of the 2022 federal budget will focus on those aspects of the budget that may impact advisors, the financial services business, and the clients we mutually serve. A short infographic has been prepared for your use, and as always, stay tuned for updates. The document, this presentation, reflects the views of Empire Life as of the date published, and the information in this document is for general information purposes only. It's not to be construed as providing legal, tax, financial, or professional advice, and we assume no responsibility for any reliance on or misuse or omissions of the information contained in this document. Some $10 billion has been promised to support housing over 5 years, 80% on the supply side, with flows to municipalities and provinces. We see more money for municipalities to support the Rapid Housing Initiative to support vulnerable populations. There is a commitment to extend the program as well and increase funding for the Reaching Home program to reduce homelessness in Canada. The budget aims to double the rate of home building over the next decade from 200,000 units to 400,000 units, with a commitment to increase the pace by 100,000 units over the next 5 years. There will be an extra $4 billion for the new Housing Accelerator Fund and $1.5 billion for CMHC's Rapid Housing Initiative. And there's rent-to-own programs to help younger Canadians and those with lower incomes get into home ownership with a goal to build 6,000 co-op housing units. There's also a very minor one-time payment of $500 for Canadians to help with housing affordability issues, but how that's going to work and whether that's really significant will be determined over the next year. Clients may be interested in how all of this is going to affect their families generally and what specific measures may help with a household's ability to buy a home. Welcome to the tax-free First Home Savings Account, where qualified individuals can put up to $40,000 into a plan like this, have that money grow on a tax-free basis. Contributions are tax deductible. Transfers from rich retirement savings plans are permitted. You can make tax-free withdrawals to buy that first home. Unused amounts can be rolled over to a rich retirement savings plans. And the account must be used within 15 years of opening the account. And there's some other rules as well that may in fact change between now and the time the bill reaches royal assent or the time it's actually implemented in 2023. So this account may only be used to buy one home. First-time home buyers are defined as Canadian residents who are at least 18 years old and have not lived in a home they owned in the year or the preceding 4 years. Individuals may contribute up to $8,000 per year. That's doable for couples who each open a plan. Unused annual contribution room will not be allowed to be carried forward. Contributions and growth accumulate tax-free, as I just mentioned, and withdrawals to buy that first qualifying home are also tax-free. The account must be used to buy a home within 15 years of first opening the account. If not used for a qualifying first home purchase by that time, then the account will have to be closed and unused savings either transferred into a Reg Retirement Savings Plan or a Reg Retirement Income Fund, or withdrawn on a taxable basis. Rollovers to a Reg Retirement Savings Plan, for example, are in excess of those RRSP contribution limits. This proposal may make it easier to approach younger prospects and clients about saving money using products we are licensed to sell. In turn, it offers the opportunity to develop relationships with younger people earlier in life that hopefully are nurtured through the years. So watch for companies getting registered to offer these plans with a targeted effective date in 2023, and again, expect some changes to the way this is all being assembled. All of this also means that Reg Retirement Savings Plans can be used for what they were intended for, and that's long-term savings for financial independence. Tax-free savings account tax-free withdrawals can become tax-deductible contributions to this new plan. The TFSA room opens up again the following year, and the benefits in both plans are essentially the same. Remember, this target group is likely to benefit greatly from intergenerational wealth transfer in the coming years, as noted in presentations that we have delivered. Go to our TRIPS webinars for a refresher. The Home Buyers Plan is still available, a program where an individual may withdraw up to $35,000 tax-free from a Reg Retirement Savings Plan to purchase or build a home on the basis that amounts withdrawn will be repaid to the Reg Retirement Savings Plan over a period not exceeding 15 years. An individual will not be allowed to make a withdrawal from this plan and the tax-free first home savings account for the same home purchase. The first-time home buyer's credit will be doubled to $10,000 retroactive to January 1st of 2022. The resulting $1,500 tax credit may be shared between spouses and common law partners. The first-time home buyer's incentive is being extended to March 31st, 2025. It's being doubled to $1,500. And this incentive allows eligible first-time home buyers to lower their borrowing costs by sharing the cost of buying a home with the government. The home accessibility tax credit benefit is also being doubled to $20,000, providing a tax credit up to $3,000. And this will help with home modifications of interest to people that have mobility issues. The budget introduces a multi-generational home renovation credit for families, adding a second unit to their home for seniors or disabled relatives. Seniors are defined as individuals age 65 and over at any time during the tax year once renovations are completed. A relative may be a parent, grandparent, child, grandchild, brother, sister, aunt, uncle, niece, or nephew of the person filing for the benefit. The spouse or common law partner of one of those individuals also qualifies. A disabled relative is someone age 18 and over who is eligible for the disability tax credit. So up to $50,000 of renovations will be covered, generating up to $7,500 in refundable tax credits. And that means you can get money even if you don't have taxable income to offset it. And this measure will help with family discussions on aging in place and the cost of keeping vulnerable family members together. Home ownership remains a hot topic for clients and their families and financial planning. Budget 2022 announces an initiative to work with provinces and territories over the next year to build and implement a home buyer's Bill of Rights and bring forward a national plan to end blind bidding. Among other things, the Home Buyer's Bill of Rights could also include ensuring a legal right to a home inspection and ensuring transparency on the history of sales prices on title searches. A gain from a quick flip of a residential property can already be subject to full taxation as regular income when the purchase was motivated by the prospect of a resale at a profit. This has become fairly common over the last 5 years. A new proposal would apply when the homeowner attempts to claim the principal residence exemption on a home and the home is sold within 12 months of purchase or transfer of title. It also applies to rental properties bought and sold within 12 months. The gain would be taxable as business income. This would serve to grab scenarios where someone in a hot market faces an opportunity to sell a recently purchased home. The improvements would be added to the cost base. Exceptions would be available if the sale was prompted by a new job outside the area, separation or divorce, disability, death, or a pregnancy that drives the need for larger accommodations or a different layout. This will impact certain clients and provide an opportunity to discuss tax planning. Specifically, the government will also explore a 2-year ban on foreign ownership of non-recreational residential property. There will be exceptions for refugees and foreign students. Speculative trading can include the resale of housing before it has been constructed or lived in. This is called assignment sale. The budget proposes that all assignment sales of newly built or substantively renovated residential housing will be subject to GST or HST effective May 7th, 2022. The Environment Minister announces $9.1 billion in new investments as part of the Emissions Reduction Plan. This spending package focuses on residential eco-friendly renovations, electric vehicles, and agriculture. The carbon capture investment tax credit for industries announced in last year's budget is being enacted. Combined with new spending and investment proposals, these measures may boost interest in investing in going green and specifically talking about Empire's ESG funds. There's a growing list, as you can see, of initiatives and tax credits going into effect and being proposed. Combined with new spending and investment proposals, these measures may provide opportunities again to discuss client interest in investing in going green and Empire's ESG funds like the Empire Life Global Sustainable Equity Guaranteed Investment Fund, which is an internally active management fund and one of the few in the segregated fund space. So an opportunity to get that conversation going and perhaps make some sales in that area and provide some distribution and allocation of investments across a broader spectrum of investments. The budget makes broad statements about potential new tax credits, as well as reviews of existing ones aimed at helping out the aged, disabled, and those families supporting them. When they are ready to announce actual changes and enhancements, we will get back to you. There are a couple of things that the government is working on. Advisor-client discussions sometimes cover pension plans and the security of those plans for members and those leaving employers. Some discussions revolve around whether to maintain membership in the plan when leaving an employer or moving monies out to a locked-in retirement account due to concerns over pension plan sustainability. This year's federal budget proposes to amend the Pension Benefit Standards Act of 1985, as well as the Pooled Registered Pension Plans Act. The aim is to improve both the long-term security and sustainability of federally regulated pensions for all members and retirees. Amendments will be made that improve governance and administration, as well as introduce new frameworks dealing with solvency reserve accounts and variable payment life annuities. And that may change the nature of some advisor-client conversations, as well as planning tactics. A few items in the budget focus on a target market for Empire Life, lower and middle income households, as well as those working at small and medium-sized businesses who may not have employee benefits or offer limited benefits. It may influence discussions with group prospects and clients. Dental care will be provided beginning with children under the ages of 12 and then expanding to include children under age 18, seniors, and persons living with a disability, as well as low-income families over a 3-year period. It will target household income of less than $70,000 a year with a phase-in or perhaps a co-payment between $70,000 and $90,000 of household income. The Liberal NDP agreement is staking out a commitment towards a Canada Pharmacare Act by the end of 2023, and a national pharmacare program is being priced at around $5 billion in the first year, increasing to over $11 billion in the ensuing 3 years, with the aim to provide Canadians with more affordable drugs. And to round out the list, the budget focuses on supporting families. Specifically, it proposes on expanded definitions of patient under the medical expense credit to include expenses paid by the taxpayer or their spouse or common law partner for the taxpayer, spouse or common law partner, a surrogate mother, or donor of sperm, ova, or embryo incurred in Canada effective for the 2022 tax year. The credit applies for expenses exceeding the lesser of $2,479 or 3% of the taxpayer's income, all designed to support families who are having problems conceiving a child. And of course, billions more being promised to provinces and territories for targeted health-related issues. There are some business measures I want to spend just a couple of minutes talking about. Banks and insurance companies were considered essential services during the pandemic, and now they're being faced with increased corporate taxes, an extra 1.5% on taxable income earnings over $100 million, and they're being told they're going to have to pay a one-time Canada Recovery dividend to the government at 15% on 2021 profits over $1 billion, payable over 5 years. So that's like a retroactive tax. So that extra bank on banks and insurers is based on a shareable exemption of $100 million of taxable earnings of members of a group that are banks, life insurance companies, and other related financial institutions. That's to bring the threshold down. The tax is targeted to begin for tax years ending after budget day. Will this have an effect on something like dividends on permanent participating life insurance or premiums and other issues? Well, there's likely no cause for concern in the short term with respect to dividends on permanent participating life insurance. Remember that pricing and profits are impacted by a number of factors that include claims experience, now rising interest rates, other investments, competitive pressures on pricing, and other expenses. And we'll look at this as part of normal reviews. We do promote strategies designed to reduce the impact of the passive income tax rules in corporations by putting forth concepts that talk about repositioning corporate assets and looking at permanent participating life insurance as an asset class in corporations. The top marginal tax rate for individuals in Canada averages 50%. And this rate also applies to passive income of Canadian-controlled private corporations, or CCPCs. If the company isn't technically owned by a Canadian resident or is owned by a public corporation, then the tax rate on passive income is only 25%. And that's been driving another strategy, perhaps even a competing strategy to the ones that we talk about. Many corporations have been taking measures to stop their CCP status, moving their business head office outside Canada, having foreign ownership, or having a public corporation ownership. It's still very much run by Canadians, however. The budget introduces a new concept, substantive Canadian-controlled private corporations. How is that being defined? It's a private corporation other than a Canadian-controlled private corporation that at any time in a tax year is controlled directly or indirectly in any manner, whatever, by one or more Canadian resident individuals, or would if all shares held by Canadian resident individuals were owned by a particular individual resident in Canada being controlled by that particular person. It may not qualify as a CCPC or Canadian Controlled Private Corporation under the old rules, but under the new measures, it will now, if it's still ultimately controlled by a Canadian resident. Passive income will then be taxed at 50% instead of 25%. The new concept will be effective for tax years ending after budget date, unless there was a signed deal before April 7th, and then it will fall under the new rules after the business is acquired by the public company or non-resident. In addition, investment income earned by a Canadian subsidiary of a foreign company will also be taxed at 50% instead of 25%. So anticipate a complex set of rules to target companies involved in this scheme. But the thing that we should be walking away with on this and the action item is to use this as a door opener to talk about insurance-based strategies that reposition assets to shield the passive income generated from annual taxation that aren't going to be covered by these rules and are certainly supported by the Income Tax Act in Canada as it stands right now. There are some positive changes in terms of the small business deduction, perhaps not appealing to really small business, but medium-sized businesses that still are looking at qualifying for that reduced income tax rate on the first $500,000 of taxable income. Currently, there's a phase out on the small business deduction when a corporation has $10 to $15 million of taxable Canadian capital. It's proposed for tax years after April 7th. They're going to raise that full grind to $50 million, which means a slower grind. They're going to extend it, and that means more of a deduction, access to the deduction from $10 to $50 million of taxable income for existing clients. More of a deduction. So what does that mean? It certainly doesn't impact the passive investment tax rules or the grind down of the small business deduction of $5 for every dollar of passive income over $50,000 for small businesses, for most small businesses, but it does potentially leave medium-sized companies a longer grind down range. And that may leave them with more after-tax cash, money that can be used to fund employee benefit plans and perks, life insurance needed for business needs like capital gains, key person, estate utilization, and so on. Now, you will recall a private member's bill, C-208, which was designed to facilitate genuine intergenerational transfers of an interest in a small business beyond farm and fishing companies. The bill was enacted on June 29, 2021, only to be followed by a Department of Finance announcement the following day that it would delay implementation until January 1st of this year. The Minister of Finance reaffirmed that Bill C-208 was law on July 19, 2021. But uncertainties remain because the government has expressed concerns. One concern is an exception to Section 84.1 of the Income Tax Act that may unintentionally permit surplus stripping without requiring a genuine intergenerational business transfer. And that's created uncertainties for family business succession planning. CALU, the Conference for Advanced Life Underwriting, has been encouraging the government to collaborate with key stakeholders on implementing Bill C-208 to facilitate genuine intergenerational transfers of shares in small businesses while preventing tax avoidance that undermines the equity of Canada's tax system. So a consultation process going to June 30th with announcements likely in the fall of this year. Budget 2022 indicates that the government is now making this issue a priority and looking to eliminate the uncertainties that remain in the framework of facilitating intergenerational transfers of a family basis on a broader basis. And that's welcome news to small business owners of all kinds. It should prompt discussions between advisors and business owners on the best way to make sure family business succession happens, and including insurance-funded strategies to take care of contingencies, to make sure those liquid dollars are there when the time comes, and to take care of estate equalization for family members not involved in the business. Employee ownership trusts are aimed at enabling broad-based employee ownership of companies. Social Capital Partners produced Building an Employee Ownership Economy in October 2020 as one way of growing this type of corporate ownership. The report noted that there is a large body of research from around the world that points to employee ownership trusts as a powerful tool to reduce inequality, support business succession, protect local jobs, and promote economic resilience. It's been noted in other countries that this structure can improve company performance and build local economies. Employee ownership trusts are the world's most successful form of employee ownership. The consultation with stakeholders found that there was a lack of dedicated vehicles under the current tax legislation. So people weren't sure exactly how to set these things up and what to rely on to make sure it's set up properly so that it wouldn't run afoul of the income tax rules. So the proposal now is to set up a new dedicated trust under the Income Tax Act. There will be continued consultation to finalize those rules and address those barriers. And we will think about the risks, tax liabilities, and other needs for liquidity, which life insurance funding may address in this new structure. Budget 2022 proposes that financial institutions be required to report the total fair market value of each and every registered retirement savings plan and registered retirement income fund annually to the Canada Revenue Agency. Again, just like for tax-free savings accounts. And it's being driven by the same type of concern, a concern about whether high, very high balance plans truly hold qualifying investments, and what's happening is in the spirit of saving for retirement using these vehicles. Now recall this particular slide from a recent webinar. According to the 2017 survey from Natixis Global Asset Management, only 22% of investors say that their advisor has focused on the tax implications of the type of investments and income actually being earned. 46% of advisors say they aren't having conversations with their advisor about tax-efficient investing at all. Almost 60%, 58% of investors would fire their advisor if another one could better advise them on the impact of taxes on their portfolios. And the scary finding here is that 70% of overall respondents did not have a planning session with their financial advisor in the past year. And that's from the annual CIBC Financial Priorities Poll that we released in January, just several months ago. Advisors who choose to discuss such matters with their clients will be part of a small and attractive group from the client's perspective. It's a great way for advisors to differentiate themselves from competition and to add value to their clients from their perspective, something that I've emphasized repeatedly in past seminars and retirement income workshops. Budgets can be a trigger for conversations. The changes and those items left alone, like the capital gains inclusion rate remaining at 50%, provide an opportunity for advisors to sit down with clients and review costs and tax efficiency as part of holistic financial planning. Numerous studies point out that today's clients want and expect advisors to listen to their concerns and meet their expectations, to listen and understand their stories, including issues, dreams, and priorities that may fall outside pure financial matters, so that advisors can really appreciate what clients are trying to achieve and why, and what's bothering them, what's keeping them up at night. To take and offer a more holistic approach to dealing with clients, including a whole family approach that takes into account other generations, and have conversations that go beyond product and be engaged in processes that move beyond financial planning to lifestyle planning. And a lot of the measures in the budget talk about those sorts of things. We trust that today's sessions will help with conversations. And as a reminder, this targeted overview focused on those aspects of the federal budget that may impact advisors, the financial services business, and the clients we mutually serve. As in previous years, more details will follow. Stay tuned for updates and webinars, written material, including that summary infographic that has been sent off. Thanks for listening in, and thanks for supporting Empire Life as a partner in your business.